Good afternoon, everyone. I'm Tim Richards, Technical Services Manager of the Managing General Agents Association. And on behalf of the MGAA, I'd like to welcome you to our briefing this afternoon. This is being delivered by MarshBerry on the subject of lessons from abroad, delegated authority trends in the USA. Before I introduce our presenter, I'd just like to run through a few housekeeping points. Please ensure your microphone and camera are turned off. If you'd like to ask a question, feel free to use the chat button at the bottom of your screen. Time allowing, these questions will be asked and answered at the end of the event. If we run out of time, questions will be answered after the event. This presentation is accredited for CPD hours if relevant to your ongoing professional development program. The briefing is being recorded and a link to the recording will be issued post-event together with our feedback survey. Please take the time to complete our survey. It takes no longer than 2 minutes and allows us to continue to deliver the best possible future events to our members. So once again, today's briefing is on the subject of lessons from abroad, delegated authority trends in the USA from MarshBerry. Let me introduce you to our presenter, George Bucur, Managing Director and Co-Head, Specialty Practice at MarshBerry. Focusing on specialty distribution and markets within MarshBerry's financial advisory practice, George brings to MarshBerry extensive knowledge in merger and acquisition transactions. In addition to being a trusted advisor to sellers and buyers within the specialty insurance arena, George provides valuation, succession planning, strategic planning, financial benchmarking, and other financial consultative services. Working with program managers, managing general agents, managing general underwriters, wholesale brokers, carriers and firms ancillary to these operations, George is privy to insights, proprietary knowledge and best practices directly impacting firms in today's dynamic economic and rate environments. George uses his experiences to educate clients and colleagues within the industry and to offer superior client services. And just a note that you can meet George at our annual conference on 10th July at Old Billingsgate, London. So do feel free to introduce yourselves. And without further ado, enjoy the briefing, everyone. And George, over to you.
Tim, thank you very much for the opportunity, and same to the MGA Association. It's a pleasure to be here today. All right, so lessons from abroad. Very much looking forward to the opportunity to share some of the insights that MarshBerry has gleaned, largely at a global perspective, but really focusing on the U.S. as they make up the dominant premium volume of delegated authority in the marketplace today. As far as an agenda, you can see it on the screen. We'll go through some learning objectives. We'll talk about MarshBerry at a very high level. We'll talk about the state of the U.S. marketplace when it comes to delegated authority, the prominent trends that result, and then we'll have some takeaways followed up by any questions. So as we get started, I appreciate the introduction from Tim and my bio. Just one thing to note about myself personally. My family and I relocated from the States to Amsterdam, where MarshBerry has our European headquarters last August. I'm on a secondment to build out MarshBerry's specialty capabilities at more of a global level. And hence we use the opportunity and insights that we get to talk to others in the marketplace, use that to build relationships, and ultimately provide guidance into where the market's been, but more importantly, as to where it is going. Hence our conversation today. As far as learning objectives, they're on the screen currently. We'll talk about the growing MGA marketplace in the States and how that translates to implications to the UK and elsewhere from a global perspective. With the massive growth that we've seen in the delegated authority space, we're going to touch on the mounting pressures that are building and what firms are doing to adapt and or change themselves or the industry on that front. And then finally, or I guess not finally, but then we will talk about the growth strategies that firms are doing to grow in the marketplace and remain relevant. And then finally, we'll talk about how the M&A environment is a key catalyst in forming the ever-changing dynamics that we experience. To get started with MarshBerry, now I'm guessing maybe some of you have heard of MarshBerry. To be clear, we are not in any way related to Marsh McLennan. We are an independent organization based out of Cleveland, Ohio. We have 5 other offices in the U.S. As I mentioned, I'm in Amsterdam in our European headquarters. And most recently, we acquired a firm in, let's say 2023. We got FCA approval called IMAS. I'm guessing many of you are much more familiar with the IMAS organization. Ali Lawton Scott and John Nisbet run the insurance side of that organization. We formally partnered with FCA approval in February, and it has just been a pleasure working with those two very professional individuals on the insurance side, and then Fred Hansen on our wealth management side. Getting back to MarshBerry, we have roughly 240 colleagues currently, if you include our intern class at this time. And we took on private equity from Atlas Merchant in February of 2022, which has allowed us to grow and reinvest into our organization. I think a couple key points here is MarshBerry is almost exclusively invested into the financial services segment, with a vast majority of our resources going to insurance distribution, as well as wealth management capabilities. And we take a lot of pride in regards to how we structure ourselves and how we bring content and thought leadership to the marketplace. We invest heavily in the market and into our proprietary insights, and I hope you get that sense as we talk through these next few slides. In regards to our new colleagues, the IMAS team, which again we acquired in February, they have a very deep presence within the UK marketplace and have been the number one advisors in this segment for a long time, just like MarshBerry from a corporate level has been the number one advisor from an M&A perspective in the States for the last 25 plus years. To give some perspective in regards to MarshBerry's specialty capabilities, and I will take time and pause and define a few things as I realize the American English nomenclature is going to be different than the proper British nomenclature. And that's going to vary from geography, from lines of business. So I'll do my best to clarify what I'm referring to. But generally speaking, when we say specialty in the US, we're referring to those firms that have delegated authority. So MGAs, MGUs, cover holders, program managers, and the like. And those that sit between the retail broker and the ultimate risk taker, we refer to wholesale brokers. They could be referred to service providers and other references as well. But over the last 4 years, from 2020 to 2023, MarshBerry is represented from a sell side perspective over 55 sellers. They've brought in total about $2.5 billion of enterprise value. And it shows that we have invested in a segment and as a result have been the number one advisor with specialty firms for the last 6 years. Also, we hold a specialty conference. We call this Peak. It's held on an annual basis in the States, and it is focused solely on specialty distribution, nothing else. So let's get started. And to kick things off, I want to start on a very positive note, as we all should be very excited about the opportunities and the presence that the insurance distribution segment specifically has in the marketplace. We ask the question, is this the greatest industry that exists? If you look at the general recurring nature of the business, the high cash flows that are oftentimes generated, the ability to control margins, and the fragmented marketplace that we're in that creates a lot of growth opportunity, coupled with high barriers to entry. I mean, relationships are core to this industry, and relationships have to be earned, which provides a protective wall against a lot of the revenues and or other streams that insurance brokers and agents demonstrate. There is a requirement to purchase insurance a lot of times, which puts a floor on the industry, and effectively, and especially in downturn economic situations, it provides a solid amount of resiliency in terms of insurance products and what it generally offers to the marketplace. All of these things beg the question, is this the greatest industry? When we look at the dynamics, specifically now focusing and shifting to the US, and throughout the presentation, I'll be talking about the US dynamics, what the potential implications might be within the UK, and further, what is the same versus different or similar versus varies between that of the US and the UK, and probably in certain instances extending it out to more of a global perspective. But what we have seen is this blurring of the lines in the insurance distribution segment, specifically in the US. And while firms used to have their lanes, used to have a retail broker that would just do retail brokerage, you would have wholesale brokers that would act in that capacity, and then you would have delegated authority organizations doing their thing. we have now seen these massive conglomerates come together that really blur all three of these types of opportunities or business types in the market. So it's very common to see the largest brokers specifically having attributes of retail agents, wholesale brokers, and delegated authority firms. And that is going to be a big influence and theme you hear throughout the rest of this presentation. Also, when it comes to delegated authority organizations, keep in mind we're talking premiums on a U.S. basis. The general theme is that we need to fight for our relevancy. Between capacity challenges, distribution, new products, technology, the list goes on. There are a lot of challenges for an industry that is inherently hindered by concentrations, whether it's one or limited capacity providers, whether it's one or limited distribution providers, or a key internal underwriter. There are inherent concentrations with those in the marketplace, specifically the independent operators. So as you look around along this evolution, essentially path that we have here, we say that in the United States, to be and remain relevant, you need to be around $1 billion with a B dollars of premium. Now, every firm is not $1 billion in the US, but we have seen this number expand significantly over the years, which we'll talk about later on. But the key theme or concept to pick up here is that as firms add premium volume, they tend to add new lines of businesses, new lines of coverage, more markets. They start to dilute out or diversify those concentrations of business that are otherwise inherent in the independent operators. Again, another theme we will be touching on throughout the presentation. So as we look at some of the most prominent trends that we are seeing in the marketplace, you see the top 10 on the screen here. We're going to go through each of these in a little more detail. As you think about these trends, I will be trying to address, again, the potential implications to the UK, but if there's any questions, as Tim pointed out along the way, please don't hesitate to ask. When we think of the overall market size, the US has been in an unprecedented firm to hard market for the last 5+ years. MarshBerry defines a firm market as rate pricing increases of 5% or more. And as you'll see in a few slides, we've seen rate increases that are well in excess of that. Typical hard markets in the States usually last for 12 to 18 months with a 5 to 7 year period of more soft conditions. It's been quite the anomaly, and a lot of it is being driven off of inferior underwriting results as the claim environment has evolved adversely in many cases from a risk-taking standpoint. Also, we've seen a massive movement of premiums in the States from admitted products to that of the E&S segment. Now, maybe some of you are familiar with the excess and surplus lines or non-admitted. Those all mean the same thing. But let me put a little definition around these. The admitted market in the United States are policies that are admitted to the state regulators. We're regulated at a state basis in the US. And those prices are then approved, and the forms and conditions of the policies are approved by the regulators. The E&S segment, or the surplus line segment, is essentially free of rate and form, meaning the underwriter has the ability to create pricing, whether it's through the rates and or policy terms. And that segment has been relatively small historically, but is growing significantly in prominence. A lot of it being because the regulators are not allowing prices to adjust accordingly in cat-prone areas, such as California and Florida and other areas. And as a result, those admitted markets are creating E&S markets and placing their business there. We're also seeing a lot of new product development. We've seen this in cyber, but we've also seen it now in cannabis, which is getting to be more mainstream in the US, and new parametric products that are coming out as of late. And then we've also seen the lifeblood of most MGAs and cover holders in the segment, that of their capacity, starting to expand. Lloyd's is coming back online after going through decile 10, and we're seeing the emergence of fronting carriers and other carriers getting specific to delegated authority products. Now, as I alluded to, the claims environment has gotten to be pretty challenging with litigious actions, natural disasters driving up claim amounts, social inflation, and other factors that continue to put pressure on the underwriting profitability. From a market size perspective, MarshBerry estimates the specialty marketplace is around 180 billion in premium. That comprises around 20% of the US P&C marketplace. And of that 180, roughly 100 billion of that is placed to the delegated authority marketplace. What is relevant about these numbers is that over the last decade, we've seen specialty distribution go from roughly 9.5% to over 19% of the P&C marketplace. So you have a percentage that is doubling, more than doubling, as a relevancy factor within the market, but you've seen premium volume also just really take off during this period of time. And it's this growth that is attracting a lot of attention from the buyer community, from the carrier community, and that of the regulation community, among others, that continues to shape and transform how business gets done. When it comes to the premiums placed, you'll see that the total surplus lines and the domestic professional, which effectively are US-based carriers providing capacity to delegated authority firms, has really been growing over the last 5 years at a very strong rate. The Lloyd's of London marketplace essentially being taken out the first few years and having relatively modest growth compared to that of the US carriers, domestic carriers. Like I said earlier, has started to come online, and that is providing new opportunities for several MGAs in the market. Getting more granular on the rate changes, you can see this being broken out by coverage. You can see that while the overall rates are coming down the last several years, they still remain in that firm definition of 5% or more that MarshBerry previously defined. This is causing a lot of opportunities and growth as well. When it gets to the carrier relationship, obviously carriers are critical to a delegated authority organization. But with this aggregation, with the consolidation of firms in the marketplace, those firms are now packaging programs, whether it's from a delegated authority risk, like industry perspective, a coverage perspective. They are packaging programs and premiums and taking it to the carriers. Well, historically, a carrier might have said, if you have 5 million of premium, we'll entertain having a conversation and setting up some sort of a delegated authority type of arrangement. Now those carriers are saying, how do we get to 50 million or plus in premium? We've seen some of these over 200 million of premium, where it's a package of premium that the carriers are now participating on the risk front. Also, because of those languishing loss ratios that we've seen within the delegated authority space, we have seen an unusually high number of delegated authority firms losing their capacity. Now, we feel that this bridge has been hurdled with a series of favorable loss results from some notable carriers. But 2023 was a fairly unique year where we heard an unusual amount of delegated authority firms losing their capacity, and some of it, surprisingly, was not necessarily related to the firm's direct underwriting results, but overall macro decisions being made at the carrier level. So it's something we continue to watch. And we feel that there will be a continued focus on underwriting results as we go into 24 and beyond for several reasons, which we're going to talk about on the next few slides. I think the big theme that we need to take from these dynamics is that relationships are a two-way street. I feel that sometimes carriers might make snap judgments based off of short-term financial decisions. And in the MGA side of things, I think, again, they're oftentimes making, or not oftentimes, but sometimes making snap decisions based off of maybe, let's say, a higher commission rate. But I think the fabric that really holds the insurance sector together are those relationships. And then we need to continue to keep that in mind and stick to the true values of what has made what has worked on a historical perspective. One of the big factors that is creating capacity in the States is that of the hybrid fronting market. And this is, although a relatively new evolution within the UK segment, we have seen the fronting capacity of non-affiliated MGAs. When I say non-affiliated, that means those are MGAs that are not owned by their carriers, so they're independent MGAs. But we've seen the overall segment go to around 15 billion where fronts are providing that capacity. 15 billion of the 47 billion that is placed in 2023 roughly is 36%, and it continues to be a big factor and a big catalyst that is allowing delegated authority to grow. The question is will fronts have the same impact in the UK as they've had in the US? Over the last 7 years, we've seen a number of fronting carriers emerge, most of which are private equity backed. There's roughly 25 fronts in the US today, and a lot of those are going through transactions. And it's a little interesting dynamic because most carriers that we work with, that we see in the marketplace, aren't private equity backed. But private equity backed investments have gotten so significant in the fronting side of things, and with their general theme of selling every 5 or so years, we're seeing almost half of the fronting markets in the market or have recently transacted. So it's a very interesting dynamic. Another interesting dynamic is we've seen in certain instances where the fronting carriers have gotten themselves into trouble by either not following or ensuring that underwriting standards are implemented when placing policies, or having other regulatory challenges. So this is something that continues to be under the microscope in 2024, as most of these events happen in 2023. Next, we pivot to that of the capacity. In the capacity front, or from the capacity front, we are continuing to see the risk takers want to see their MGAs, their delegated authority partners, take more skin in the game. Now, that means different things to different firms, but it might come in the form of a profit share rather than a higher commission. It might come in the form of a sliding scale commission that is predicated upon the overall loss ratios of the delegated authority organization. Oftentimes, those sliding scale commissions can have a clawback effect, which can be viewed adversely from a valuation perspective coming from the M&A advisor. So that's just my 2 cents there. Also, we see MGAs that are sometimes setting up captive arrangements. This is where they take reinsurance risk on the back end, maybe not all that much. It could be anywhere from 5 to 30%, but it's sometimes absolutely more than that. It really depends on what dynamics the MGA is facing and the lines of businesses and the coverage from the reinsurance and primary capacity providers. As I mentioned, we've seen Decile 10 coming back online, and we've seen alternative capital, whether through the ILS, captives, or other, getting to be much more prevalent in the States. And this has really been an evolution that is being fueled by the firm market that we experienced for the last 5 years. Effectively, when it comes to the alternative capital, they're trying to take advantage of situations where maybe the rising tide of insurance pricing isn't applicable for all risk takers, and they're trying to create bespoke solutions for firms that might have a different risk profile than their general homogeneous group of risk takers. And then when it comes to the various conditions, we continue to see reduced limits, lower ceding commissions, and increased retention rates in regards to mainly cat exposed areas, but now we are starting to see this in other segments as well. When we look at the underwriting data and the results, it is an enigma to me how we continue to have delegated authority organizations that don't have access to their underwriting results. It is something that is changing dramatically in the States, and it will continue to do so over the next several years. If you look at the overall P&C marketplace, you can see that the last 2 years had combined ratios north of 100%, meaning the carriers weren't generating profit. They're actually losing money on their insurance operations, being offset by that of investment returns, which have gone up over the last couple of years given the higher interest rate environment we're in. But we still see challenges in regards to insurance profitability. And specifically, 2024 is being targeted as a cat-prone, just bad year based off of the higher temperatures that we're globally seeing. And I think I read something yesterday, how the oceans are 1 or 2 degrees higher than they've ever been for the last year. That is going to fuel hurricanes, tsunamis, and other natural disasters, which will be very interesting to see how it develops in 2024. I'm not going to go into a lot of detail, but we see continued pressure on the reserves. We touched on this previously in the presentation. but these factors will continue to put a floor on the insurance pricing. So we expect over the course of the next year that insurance pricing, while coming down from a rate increase perspective, still will remain in a going upward trajectory, that north of 5%. 2023, the first half of 23 created a developed loss ratio of nearly 70% for that of the delegated authority space. When you put on top of this an expense ratio typically ranges between 25 and 30 points, you can see that the delegated authority segment specifically is generating maybe 0 to 5% profit on their delegated authority segment. It's just unacceptable. We continue to see carriers tighten on the terms that we talked about previously, and that will help to improve things, although it is a slow process. Next, we get to the concept of technology. Now, everyone, when the InsurTech revolution was going, let's say, 2 to 5 years removed from today, they talked about disintermediation and they talked about how technology was going to finally take over the insurance segment. Well, there were some significant miscalculations there in regards from a broad stroke perspective. One, discounting the value and the strength of the relationships that exist in the insurance segment. But two, in certain situations, disregarding the regulatory nature and pressures and challenges that comes along with it. That tune around disintermediation has changed drastically. And while technology is absolutely having an influence in this marketplace, it's having an influence on the margins. It's not having a broad sweeping change. And so while the first slide showed the avalanche coming down, signifying a massive change in the market, technology is actually moving more like an iceberg. It's there, it has a lot of momentum, it has strength, but it moves much slower than one might have anticipated. And that means different things to different users, whether it's from an underwriting perspective, a claims administration, policy administration, or other. Technology is being used on a bespoke way on a coverage, industry type, etc. basis, and it is having influence. Next, we get more towards the M&A side of things. We talk about the rise of the consolidators. On the screen right now, you have the top 20 brokers in the U.S. by revenue dollars. This is per the 2023 Business Insurance release that focuses on 2022 revenue amounts. Notably here, while NFP and Aon have now merged, they're listed separately on this slide, 16 of these 20 firms based off of the 2023 ranking had specialty platforms. And again, specialty being that of delegated authority and or wholesale brokers, because in the States, the firms that have had the most success and have gone down that relevancy path have had various attributes. And most of that means they have the combination of both wholesale brokerage as well as delegated authority in their overall ecosystem as they try and capture more of the commission pie. More to come on that in a moment. But as we've seen this essentially unlocking of value through these partnerships, as a lot of those consolidators on the previous slide, almost all of them have gotten through there to where they've been through a combination of organic and inorganic growth, inorganic being M&A acquisitions. But we've seen this partnering of retail brokers with that of delegated authority and wholesale firms as one of the very, very strong means to growth. We've seen an expansion of historical wholesale brokers getting into captive management, claims administration, wealth management, and more. And we've seen an expansion from firms that otherwise may have been purely in the life or health segment or the P&C segment, now getting into the other side, meaning a P&C firm may be getting into the health segment. And in the US, the health segment is a very robust marketplace. So there's a lot of growth opportunity there. And then finally, the reason I'm in Amsterdam right now is we see firms wanting to grow geographically. Now, from a getting outside of the US and maybe jumping over the pond to the UK, Europe, and other areas, or continental Europe and other areas, we have seen firms generally that are the public brokers make that leap, but also the specialty firms, those that are set in delegated authority and wholesale brokerage. Most of the retail brokers that are private equity backed in the States, most, not all, have stayed in the States and have not made the transition over just yet. When you look at and you take that conversation around unlocking value, what are some of the ways that those consolidators are realizing value? And so if we go from right to left here, starting at the top where it says the ability to offer multi-program deals, that's taking, a group of programs like we talked about previously to get that 50 million premium block and presenting it to carriers so it makes it more attractive. It allows them to capture more markets or opportunities that are out there because they have more clout in the market when it comes to their capacity providers. Next, we are seeing a streamlining of wholesale relationships. The largest public brokers are Aon, Willis, and Marsh. While they don't have wholesale brokerage capabilities currently, they are talking about bringing that in-house. Regardless of what happens there, the next 20 firms on that top 20 list that we showed previously, they are consolidating their wholesale panel down from 100 to 200 wholesale brokers down to 5 or 10. We're in the midst of that transition. While it's good if you're one of those 5 or 10 wholesale brokers, it is bad if you're one of those 195 other wholesale brokers, which tend to be the smaller independent firms in the market. So that consolidation is having meaningful pressures on that front. We continue to see investments, especially by those larger brokers that tend to have more of a pool of funds to reinvest into value-add services, oftentimes getting to technology, actuaries, meaning bringing actuaries in-house to do their underwriting. They use that when negotiating and whether it's terms, commissions with their carriers to get capacity and or profit share payments, and to really be more true agents of the principal, taking data, analyzing it, and leading with price changes versus being reactive. We see cross-sell capabilities. With the consolidation in the U.S., you have a retail broker that acquires a wholesale broker, a delegated authority organization. What a lot of those retail brokers are doing now are setting up centers of excellence, whether it's in healthcare or real estate or transportation, go down the list. They're then acquiring the MGAs that have expertise in that segment, either driving premium through those MGAs. I want to be clear here that they're not forcing it through. It has to work in an open market type of situation. But they're also giving data to those MGAs who can create proprietary products, whether new programs or fitting into existing programs, that again allows them to keep more of that commission pie. So they continue to grow the products that they offer, whether in-house or offering it to other retail brokers in the U.S. as well. And with all this premium volume, with this clout, those largest brokers are using that to negotiate with their carrier partners and get another points of commission or get flexibility around terms that they're placing their products on. All of that is creating net revenue, which trickles down to that of EBITDA, which is the number one driver of valuation. As we talked about, we continue to see brokers in the U.S., mainly public and specialty focused, going to that of the UK, continental Europe, and beyond. I think this is one of the most profound implications to that of the UK broker segment. If, again, being an M&A advisor, valuations for delegated authority organizations are at an all-time high. If you translate that to the valuations that we generally see in the UK and continental Europe, they're probably off by a turn or two or maybe even more from a valuation perspective. This creates, I think, a lot of opportunity for value to be realized by UK MGAs when they seek to partner with US firms that are coming over. Now, the big challenge being is that most operators in the UK need to be of a certain size for a US-based firm to come over and make a platform investment. There's only so many of platforms that are large enough, and those firms that are large enough that see that are the level of size that US buyers are seeking will be in extremely high demand. Other than that, it would likely be a US buyer coming to the UK or continental Europe and then making acquisitions, more of a hub and spoke type of model. Now shifting gears and focusing on consolidation of specialty organizations. As we talked about, The largest firms in the marketplace, as they go up that relevancy continuum, generally need to be around $1 billion of premium. If you rewind back, let's say 10 or 15 years ago, there were 4 or 5 specialty firms with $1 billion of premium. Today, there are 22 firms with $1 billion of premium or more. It's a very significant dynamic, and with that, again, comes clout, and with that comes a diversification of those inherent concentrations of business that generally exist. So when we talk about the trends on this front, there will be a continued expansion of margin is what we expect to occur in the U.S. as firms pull their resources and take advantage of those economies of scale when firms come together. Here's a stat that is, frankly, when I first saw it, pretty mind-blowing. Nearly 10% of the specialty marketplace in the U.S. consolidated in 2023. That was followed by 9% consolidating in 21 and 22 respectively. There is a very big focus for specialty firms in the U.S. because of their niche operations, their ability to diversify and or differentiate the products that they offer, but most importantly, because of their significant growth potential. We've talked about how the premiums in this segment have really taken off over the last 5 years, but at least over the last decade. And that growth potential is getting the eye and attention of buyers in the marketplace looking to take advantage of synergies that might exist with a very niche player such as a cover holder, MGA, MGU, etc. If you compare that to that of the retail brokers in the marketplace, the specialty firms are consolidating at a rate of nearly 5 times that of their retail counterparts. It speaks to the value add in this segment. 2023 saw a record number of specialty transactions in the U.S. We had 181. Most of those transactions are being driven by private equity-backed buyers, very similar to the structure in the UK. You can see that although 2021 spiked, that was because of tax changes that were pending in the U.S. that really never came to fruition. Specialty firms have held relatively strong compared to that of retail transactions. And while they might not say 181 from 179 is strong, it's flat, but the retail broker transactions during the same period of time in the United States went down by 30%. So it speaks to the continued focus of specialty firms. And of this, I want to point out the orange, the number 14 in the upper right. Those are acquisitions by carriers. While carriers are not very highly acquisitive in the States, they do find specific times when it is appropriate for them to make plays. They tend to be relatively conservative, but if you get the benefits of underwriting profitability, that can change the game for how carriers view and see valuation. Another very interesting dynamic is if we separate the life and health specialty organizations from that of the P&C organizations, we see that life and health has really picked up steam over the last 4 years with their M&A transactions increasing at a 27% CAGR, compound annual growth rate, versus that of a 7% year-over-year growth rate for that of the P&C marketplace. Life and health firms are really picking up steam because what we are seeing is the largest firms, which tend to be rooted in the P&C marketplace, are now moving into the life segment or the health segment. And as such, they're making acquisitions in both of those fields. Now, when it comes to the retail broker community, these are important, obviously, because these are clients of many MGAs and or wholesale brokers. As I talked about previously, we've seen that nearly a 30% decrease in retail transactions from 2021 to 2023, but still a very robust marketplace with nearly 800 transactions last year. MarshBerry expects we'll have somewhere between 800 and 900 transactions in 2024, with a big focus of those transactions happening in the back half of 2024. I should note that if you look at specialty as a percentage of the overall transaction activity in the States, last year peaked at around 22%. We've seen it change between 13 and 22% pretty much over the last 7 or 8 years. Coincidentally, or maybe not, we've seen specialty transactions right around 20% in the UK for many of the last several years, It's a little lower this year, but we expect, just like in the States, for those transactions to come back the second half of 24. Now let's get into maybe an unspoken growth theme within the insurance segment. And it looks like I have a slide that is out of place. But what we are seeing is that you have traditional organic growth, which is the expansion of premium by new clients, exposure base, et cetera. You have M&A acquisitions where a firm goes out and buys another company. But now you have this kind of in-betweener where firms are identifying and recruiting either books of business or underwriting talent and bringing it in-house. And because of that, what we've seen is that there's been a significant growth opportunity kind of on the fringes where firms have gone out and rather than making M&A acquisitions, which tend to be fairly risky and cost tens, if not hundreds of millions of dollars, they're going out and identifying underwriting talent, whether through carriers or competing agents and brokers, bringing it in-house and allowing them to grow by giving them back office services. This migration of underwriting talent is having implications on many factors, and specifically when it comes to the carriers. Now, what this slide does is it looks at premiums that are placed by MGAs that are owned by carriers. We refer to that as affiliated premium. Compared to that of premiums that are placed by MGAs that are unaffiliated to a carrier. Now, you can see that it's gone from 58% being affiliated in 2018 to 43% of the premiums being placed being affiliated in 2022. And throughout this time, we've seen a rise of unaffiliated premium getting to 46% in 2022 of the P&C market. The 11% in there is related to crop or agricultural type products. We're just kind of carving that out for right now. But notably, over this 5-year period, delegated authority premiums within the independent segment has increased by $22 billion compared to that of the affiliated carriers increasing by only $9 billion. We expect this trend to continue, and keep in mind these numbers as of 2022. We expect that bifurcation to continue in 23 and 24, given the amount of underwriting talent that is being brought out of the mainly risk-taking environment. Next, let's talk about the business model. As we referred to previously, the recipe for success has been the largest firms coming together, having their wholesale brokerage operations or open market broker operations, their general binding, which are essentially you underwrite to a box, you submit it to your carrier, and then they'll approve it, or your delegated authority, which gives you more underwriting discretion, taking that and combining those together. That's been the recipe for success, let's say 2 or 3 years removed. But as of late, one of the new developments that we've seen is this alternative risk management, mainly through captive solutions and others that are allowing brokers and agents to create bespoke solutions for pretty much their largest clients, but also it's going downstream and being more homogeneous types of pools where these structures are being put in place. So a very interesting dynamic and one that is changing given the 5-year firm to hard rate environment we've been in. So we're going to transition to the takeaways. I don't know, Tim, would now be a good time to maybe stop and ask for any questions, or do you want to wait until the very end?
Yeah, certainly. It would certainly be a good opportunity to remind people to ask any questions. Actually, I do have one which I can read out right away, and please keep them coming. So let me read this one to you, George. Who are the main carriers supporting DAs in the US market?
Yes, great question. So I think the point to highlight here is that there are a lot of carriers supporting delegated authority MGUs and program managers. If you look at some of the fronting carriers, again, they make up 35% of the overall premium. Some of your largest fronts that are out there are that of Transverse, which is acquired by MS Sumitomo. You have Accredited and others. But then you have this swath of firms like your State Nationals, Clear Blues, other fronting carriers that are in the marketplace. And it's not like you have a dominant sector. AIG through Lexington and AIG's core operations. There's an association called Target Markets. And if you go to target markets, there's probably going to be, I'm ballparking here, but let's say 50 to 75 carriers that will be offering delegated authority. So it's not a huge concentration into one or a couple carriers. It's fairly widespread.
Great, thanks, George.
We'll
Just
go
waiting
back in a
for.
few minutes with
Let's loop back in a few minutes. So if anyone has any other questions, feel free. We still have a few minutes left. So in fact, we have, let me see, a quarter of an hour left actually. So feel free to type them into the chat box now. And in the meantime, George, I'll pass back to you.
Thank you, Tim. So as we look at the takeaways, we expect premiums in the specialty market to continue to grow. And what we have seen is this professionalization of the delegated authority segment that continues to move east. The UK being very advanced in regards to underwriting authority, I mean, with the roots of Lloyd's of London and others in the marketplace, it's inherent in how business gets done. That's not necessarily the case in continental Europe, and we continue to see the professionalization of delegated authority continue to push east. And that's not to say that there aren't very highly skilled underwriters in that of continental Europe, but it's just a different mix of delegated authority as you push further east. We will see carriers continue to keep a critical eye on the underwriting performance. And due to the higher cost of capital environment that we're in, we are expecting a lot of larger brokers to focus on margin expansion and organic growth because it now becomes more expensive to go out and make acquisitions in the marketplace. When it comes to best-in-class organizations, we'll continue to see superior growth rates from those that are best-in-class, that leverage technology. They have more control over underwriting and their data, and they continue to diversify their various concentrations in their business. There will continue to be mounting pressures. With change comes challenges. With challenges comes opportunity. And we continue to see the fact that this market is changing at such a quick rate that is creating a lot of opportunities where firms that are agile can take advantage of it and create unique solutions for that of the retail brokers, the insureds, their capacity providers, and others. When it comes to growth, while M&A may become more expensive, it will absolutely continue into the near future. It's too fragmented of an industry for this not to happen. And while we see regeneration in the states of firms, we have the previous chart there showing how 10% of the marketplace consolidated, but the overall market only decreased by, let's say, 3 or 4 percentage points. Maybe not the same in the UK where we see consolidation, but the firms don't necessarily regenerate as quickly. What will the implications of that be in the delegated authority space as those that are independent become fewer and fewer compared to those that have more premium and therefore clout with that of their carriers, distribution partners, etc.? We will continue to see a talent migration. It's almost every day where you're reading a publication that talks about underwriting talent that is moving from a carrier to that of the service segment. That trend will continue because the service segment is able to realize and acknowledge the value that those firms are, or those individuals are bringing in a much more efficient way. And that is going to have significant impact in regards to both how MGAs operate and that of their risk-taking partners. And then capacity availability. The real question is what will capacity, how will that change in the near future in the UK? Now with London, Lloyd's of London coming on back online, but also what are the implications with the fronting carriers that are now getting established specific to that of delegated authority firms? We will see technology and its continued influence in the marketplace. And with all this attention, with all this growth, we will continue to see regulators take a more specific focus on this segment. AM Best, as of recently, as of, let's say, 2 weeks ago, has brought up this conversation coming off of the Target Markets event. Again, that's the Delegated Authority Association that happens in the meeting that happens in the U.S., talking about the importance of delegated authority to that of the risk-taking partners. So that's going to be a continued trend. And then finally, change will continue. And I think this is going to transcend geographies. But how do you take advantage of it, and how do you stay ahead of the curve to remain relevant? That's about it. Focusing back on the learning objectives, they're on your screen right now. And Tim, that leaves us open for any other questions that might exist.
Perfect, thanks, George. And yes, I do have one. So do keep them coming. And this one is, do you see scope for admitted regulators to react to the growth in the E&S sector? And if so, how?
Can you say that first part again, Tim? Do you see?
Sure. Do you see scope for admitted regulators to react to the growth in the E&S sector? And if so, how?
Yes. So the challenge being, so it's, to be clear, it's the same regulators that cover admitted and the E&S segment, because in the E&S segment, even if you aren't submitting a rate and form, you're still regulated at the carrier level to make sure you have a sufficient capital adequacy. And frankly, you need more capital adequacy than that of your admitted markets. But the real teeth, whether it comes to E&S, admitted, delegated authority, the real teeth that the delegated authority regulators could have is right now they've proposed the DUAE assessment. And I highlight the word assessment because it is not a rating like that is given to a carrier. But the real teeth that could be added is if AM Best came out and said, carrier, you risk-taking entity, we're going to influence your rating by that of the quality of the MGAs that you do business with. Meaning, if a significant amount of your premium your delegated authority premium isn't placed through highly assessed MGAs, that could have adverse implications or favorable implications, depending on the assessment, on your overall rating of your enterprise value, level rating. So that is what the market is watching. AM Best has not pivoted to that point yet, but the question is, will they? And if they do, what are the implications to that of the risk takers that are placing business through delegated authority agents?
Great, thanks, George. And I've just got another question in, actually. So let me read that to you. Doesn't workforce demographic also have an influence on the DA market? The entrepreneurial spirit seems to be returning as more dyed-in-the-mold underwriters retire, enabling fresh thinking. The MGA model seems to be appealing to younger underwriters.
That is a great question, and one that really energizes me, and one of the reasons I focused on the specialty segment myself. Delegated authority organizations allow for the flexibility for the market to adapt. And we've seen this in the US, we've seen this in the UK, we've seen this in continental Europe. But by definition, what does a delegated authority organization do? To put it simply, they bring value that their risk-taking partner otherwise can't bring. So whether it's through distribution, whether it's through technology, whether it's through policy administration, claims administration, go down the list, whether it's through a need in the marketplace. We continually see delegated authority firms and the E&S marketplace adapt and react to create these new solutions in the marketplace. And it's been really amazing to see how a lot of delegated authority firms have been on the front end, whether again, it's in the cannabis segment or cyber or parametric, but they're the ones leading the charge. And as time goes on, what you'll see is these somewhat novel or different concepts that evolve will ultimately become more mainstream. I think cyber is a great example. 5 years ago, it was the Wild West in cyber. We saw rates spike. Now that we've kind of got it under control, we're better understanding it. Still a lot of learning and evolution that will happen in that field, but it's becoming more mainstream. It's being acquired by more insureds. And as a result, you get a more homogeneous pool, and therefore you get more typical historical types of underwriting, risk takers, and processes. But it is exactly that entrepreneurial spirit that allows MGAs to create unique solutions, get a carrier to support them, and ultimately advance both the industry as well as their companies.
Thanks, George. And that's the last of the questions, and we're just about the time now. So let's leave it there. So just remains for me to say thanks so much, George, for your presentation today, which I'm sure everyone will agree has been really enlightening and valuable. You can reach George at the details shown on screen at the moment, or also please feel free to contact me at tim.richards@mgaa.co.uk with any questions or for any introductions, and I'll be happy to pass these on. Thanks also to all of you for joining us, and don't forget to provide your feedback and do look out for forthcoming MGAA events. Hope you all have a productive afternoon, and thanks again for joining us, and see you all soon. Thanks very much, George.
Thank you. Take care.
Thank you.